The siren song of passive income is a melody many of us yearn to hear. It whispers promises of freedom, of earnings that flow effortlessly while we sleep, unburdened by the clock and the demands of a traditional job. It paints a picture of financial liberation, a life where wealth accumulation happens almost by magic. But like the ancient tales of sirens luring sailors to their doom with enchanting songs, this alluring promise can, for many, lead not to freedom, but to a different kind of trap. Many voices in the financial sphere champion passive income as the ultimate key to unlocking true financial independence. They showcase seemingly effortless streams of revenue, suggesting that with a few simple steps, anyone can achieve this dream. Yet, beneath the glossy surface often lies a reality far removed from the effortless ideal. There's the hidden labor, the constant cultivation, the inherent risks, and for many, the stark, uncomfortable truth that much of what is marketed as passive is, in fact, anything but. Benjamin Graham, the venerable dean of value investing, offered a timeless caution in his seminal work, The Intelligent Investor. He warned us to be wary of speculative ventures that mask ahead as solid investments, especially those that promise extraordinary returns with little effort. It is this critical lens, this insistence on understanding the underlying reality, that we must bring to bear on the pervasive narrative of passive income. In this exploration, we will meticulously unpack three fundamental myths that ensnare ambitious individuals, especially those driven by the desire for genuine financial mastery. These myths, often perpetuated by well-meaning but sometimes misinformed advice, can transform the noble pursuit of financial freedom into a persistent, often frustrating, cycle of continuous effort and unmet expectations. By confronting these illusions head-on, we can begin to navigate towards a more sustainable, data-driven path to wealth. Myth number 1, the pervasive belief that passive income is truly passive, an effortless path to wealth. This is perhaps the most seductive and consequently the most damaging myth. The data, however, paints a starkly different picture. Consider rental properties, often cited as a prime example of passive income. While collecting rent might seem simple, the reality involves significant upfront capital, constant property maintenance, dealing with tenant issues, navigating market fluctuations, and managing vacancies. Or think about dividend stocks. While dividends are paid without direct effort, selecting the right companies, understanding their financial health, and managing your portfolio requires diligent research and ongoing analysis. Online courses and affiliate marketing, too, demand continuous content creation, marketing efforts, and community engagement to remain relevant and profitable. The passive label is frequently a misnomer, a carefully crafted narrative that glosses over the substantial, often relentless, effort involved. To truly grasp this, let's move beyond the simple label. Building a successful income stream, whether we call it passive or not, is far less like planting a magic beanstalk and more akin to tending a complex, thriving garden. You don't simply sow seeds and expect a harvest. Instead, you must meticulously water, diligently weed, consistently fertilize, and vigilantly protect your plants from pests and harsh weather. This garden requires your attention, your knowledge, and your ongoing care. Many ventures marketed as passive demand precisely this kind of relentless attention, yet this vital aspect is often conveniently omitted from the sales pitch. This brings us to the cognitive trap. We are often ensnared by the availability heuristic. This psychological bias means we tend to overestimate the importance of information that is easily recalled. The success stories of effortless passive income are amplified, endlessly repeated, while the quiet, consistent, and often considerable effort behind them remains largely obscured. Understanding this bias is the crucial first step in dismantling the illusion and seeing these income streams for what they truly are: ventures that require significant input, not just of capital, but of time, skill, and persistent effort. The goal isn't to eliminate effort entirely, but to shift our focus towards leveraged income, where initial efforts or capital generate returns disproportionate to ongoing time input. This requires a critical evaluation of the true effort-to-reward ratio. Myth number 2, the alluring notion that passive income serves as a shortcut to financial freedom. This idea plays directly into our desire for immediate results, for a quick escape from the daily grind. However, the data consistently reveals a different truth. Sustainable wealth accumulation is a marathon, not a sprint. Those who chase the illusion of quick passive income often find themselves entangled in higher risk ventures, investing in lower quality assets, and ultimately becoming more financially trapped than before. We see a clear correlation between schemes promising rapid passive income and heightened financial distress. Consider this analogy: attempting to build a skyscraper by haphazardly stacking flimsy cardboard boxes. It might appear tall and impressive for a fleeting moment, but it utterly lacks structural integrity. It is destined to collapse under its own weight or the slightest tremor. True financial freedom, the kind that endures, is not built on such fragile foundations. It is meticulously constructed upon a robust base of diversified, high-quality assets, not on speculative passive ventures that prioritize speed over substance. Many opportunities presented as passive income are, in essence, high-risk, speculative baits masquerading in more conservative attire. We must be acutely aware of the common pitfalls that lie in wait. These include over-leveraged real estate deals that leave one vulnerable to market downturns, volatile cryptocurrency staking promises that can evaporate overnight, and overhyped e-commerce models that tout rapid returns but frequently deliver significant, soul-crushing losses. The allure of speed, of getting rich quick, taps directly into our brain's reward system, triggering impulsive decisions fueled by dopamine. Recognizing this potent urge for instant gratification is absolutely crucial for making sound, long-term financial choices. The path to genuine financial freedom is paved with discipline, patience, and a focus on building truly valuable, enduring assets. Myth number 3. The dangerous assumption that all passive income streams are created equal. The term itself is a broad brush, a catch-all that lumps together vastly different financial endeavors. It's like comparing a high-yield savings account, which offers minimal return but near zero risk, to a complex private equity fund, which demands significant capital and carries substantial risk for potentially higher rewards. Lumping these together under the single banner of passive income obscures critical differences in their risk profiles, capital requirements, scalability, and, most importantly, their true potential for long-term wealth building. The data starkly illustrates that these streams exist on a wide spectrum, and treating them as homogenous is a critical error. Imagine a skilled chef preparing a meal. They wouldn't treat flour and a rare truffle the same way, nor would they apply the same cooking technique to both. They understand the distinct properties of each ingredient, how they interact, and the best methods to bring out their unique value. Similarly, to navigate the world of income generation effectively, we must understand that not all passive streams are alike. Some are foundational, offering stability, while others are speculative, promising greater upside but carrying greater peril. This myth often serves to mask hidden incentives and fees, particularly within offerings sold by traditional financial institutions or by online personalities promising the world. Many of these vehicles are structured to benefit the creator or seller far more than the end investor. We must contrast these with genuinely robust, low-cost strategies that prioritize the investor's long-term prosperity. The key is to develop a discerning eye, to question the underlying structure, and to understand where the true value lies. By dissecting these myths, we begin to cut through the overwhelming noise of passive income advice and focus our energy on what truly matters: sustainable, verifiable wealth creation, not merely the fleeting illusion of income. Let's pull back the curtain on the entire passive income ecosystem and expose the hidden fees and behavioral traps that so often ensnare unwary individuals. A rigorous data analysis of common passive income products reveals a stark reality. Upfront fees, ongoing management costs, and insidious hidden commissions can drastically erode potential returns. In many cases, these hidden costs transform a seemingly profitable venture into a net financial loss. Applying principles of forensic accounting, we can highlight these often overlooked expenses that chip away at your wealth. Consider this analogy. It's like being offered a free smartphone, only to discover it comes with an exorbitant, mandatory monthly service fee that far outweighs the initial perceived value. Many passive income opportunities operate on a similar deceptive model, where the true costs are masked by attractive initial promises. We can contrast this with the transparent, clearly disclosed fee structures found in well-managed index funds, where you know exactly what you are paying for and why. This transparency is a hallmark of genuine investment, not speculative packaging. But why do we fall for these traps so readily? The psychology is compelling. Concepts like anchoring bias cause us to fixate on the initial, often inflated, promised return, anchoring our expectations. Then, the sunk cost fallacy keeps us invested in a failing venture simply because of the time and money we've already poured into it. These powerful cognitive biases are frequently exploited within the passive income industry, keeping people trapped in cycles of disappointment. Implementing a thorough due diligence checklist for income streams is paramount. This checklist will guide you to scrutinize fee structures, understand the underlying asset's true performance, assess the seller's incentives, and identify any behavioral biases that might be clouding your judgment. Uncovering these hidden costs is not merely an exercise in caution, it's an essential step towards genuine financial security. The data, when viewed with a critical eye, makes one thing unequivocally clear: true, sustainable financial freedom is not found by chasing the elusive myth of passive income. Instead, it is built through the strategic development of leveraged income. This requires a profound understanding of asset valuation, the relentless power of compounding, and a disciplined approach to risk management. We see this in the long-term performance data of diversified, quality assets, which consistently outperform the speculative, often fleeting, ventures branches peddled under the passive income banner. Consider the wisdom of Warren Buffett. He doesn't merely collect dividends as if they were automatic checks arriving in the mail. Instead, he meticulously and strategically allocates capital to businesses that possess enduring economic moats, competitive advantages that protect their profitability over time. His approach serves as a powerful model for discerning truly valuable, income-generating opportunities from the ephemeral trends that dominate so much of the financial conversation. It's the difference between building a sturdy, well-designed house meant to last generations and erecting a temporary shelter that offers little protection against the elements. The ultimate myth we confront is the notion that financial freedom can be passively attained, divorced from rigorous thought, diligent effort, or strategic planning. The get-rich-quick narrative surrounding passive income stands in stark contrast to the proven, time-tested strategies of value investors. These individuals build wealth not through shortcuts, but through informed capital allocation, deep analysis, and unwavering patience. Our actionable insight is this: focus on developing skills that create genuine value and can be leveraged. This might mean mastering a high-demand profession, building a scalable business, or becoming an astute investor capable of discerning enduring worth. We must evaluate income-generating opportunities not by their passive label, but by their true potential for sustainable wealth creation. The poetic truth is that the pursuit of passive income often blinds us to the profound power of active creation. True financial mastery lies not in avoiding work, but in directing our efforts intelligently towards building assets that work for us sustainably and with purpose. We have journeyed together through the seductive, yet often misleading, landscape of passive income. We've deconstructed the three pervasive myths that can lead even the most ambitious individuals astray: the illusion that it is truly passive, the dangerous fantasy that it offers a shortcut to financial freedom, and the fallacy that all such income streams are created equal. The data we've examined, the analogies we've explored, and the psychological traps we've uncovered all point to a consistent conclusion. These are not pathways to liberation, but often sophisticated traps designed to ensnare the unwary. True financial freedom, the kind that provides enduring security and genuine autonomy, is not a passive inheritance. It is meticulously, intentionally built. It is forged through informed decisions, through the strategic allocation of capital to assets that possess intrinsic value, and through a profound, data-backed understanding of both risk and reward. These are the very principles that Benjamin Graham, the father of value investing, championed: the unwavering emphasis on a margin of safety and the relentless pursuit of intrinsic value, not fleeting market trends. Instead of chasing the mirage of effortless income, commit to the more robust, more rewarding path of building leveraged income streams or investing in quality assets that generate real, sustainable returns. This journey demands diligence, it requires patience, and above all, it necessitates a critical, data-driven mindset that questions every assumption and scrutinizes every promise. The financial gurus may offer enticing shortcuts, but the enduring path to wealth is paved with understanding and deliberate action. So, I ask you to reflect deeply. Is your current pursuit of income actively building lasting wealth, or are you merely tending a garden that demands constant, unsustainable effort for a meager, ephemeral harvest? The answer, when guided by data and critical thinking, will illuminate your true path. It will guide you away from the deceptive allure of the passive mirage and towards the solid ground of genuine financial mastery.